Hey everybody, John Grauman here from the Grauman Rosenfeld Group at the agency with another market update as we go into November of 2024. And all I can say is thank goodness that the election is behind us. Regardless of the outcome and who you may have voted for, I'm sure we can all rejoice in the fact that it's now in our rear view. The question becomes, what does the world look like in that aftermath? Well, I would say every different sector of the market is having its reaction. The stock market is certainly having a positive response for Trump's pro-business stance and expecting that maybe there's going to be lower regulation and lower taxes next year. Crypto is definitely having its day in the sun, and we've seen Bitcoin exceed far beyond what its peak was once before. But how is this affecting the housing market? Well, that's really driven by interest rates and supply and demand, like I've talked about before. The Federal Reserve met recently. They had their second rate cut. This time was a quarter of a point. But again, we haven't seen much adjustment to long-term mortgage rates. And I think that has a lot of people feeling confused and perplexed because that, in essence, is the bottleneck. Everyone's waiting for rates to come down to a more affordable place for all of that pent-up demand to come off the sidelines and start to re-engage. And while the sideline is sort of frothing at the mouth to get in, it hasn't yet because rates have essentially held steady. They're down from where we were a year ago, but not necessarily where we thought they would be at this point. Why is that? Well, again, it's because long-term mortgage rates aren't driven by the short-term federal funds rate. They're driven by broader economic policies and specifically the demand for long-term treasury yield. The threat of rising inflation, government spending, and lender risk is what's keeping interest rates where they are. There's been a tremendous deficit that the Treasury has been essentially printing money towards, and that keeps yields high. So that's essentially where we are right now. There's concern that if Trump is going to implement these tariffs and also cut taxes, that's going to give way to rising inflation. If we see rising inflation, the Fed's not going to be able to cut rates as aggressively as they wanted to. And again, that almost sits separately from what it's going to do to Treasury yields. I know that sounds like just sort of a word sandwich and I'm sitting here doing a bunch of verbal gymnastics on you, but that's essentially the way this all works. That's what moves the market. So looking ahead, we're going into the holidays. Things are probably going to slow down a little bit as they typically do. My expectation is that we're still going to see this market start to take off in Q2 of next year. I think come spring of next year, you're going to see that demand that just can't sit on the sidelines much longer start to weigh in. That's going to open things up, and that hopefully might be the start of the next bull run. So as I've said before, if you're a buyer, I think there's a real lull in the market right now. Over, let's say, the next 4 months as we work our way through winter, I think you're going to see opportunities and prices at a place where you're not going to see them 6 months from now. So if you're a buyer, certainly be on the lookout for those opportunities. As for me, I'm just trying to stay abreast of the market and keep you informed as information comes to me. So stay tuned for the next update, and hopefully I'll have more information for you then.